Good afternoon, everybody. We are going to give our waiting room one moment and we will get started. All right, and I have 4:30 on the dot. So in the interest of time, we will kick off. So good afternoon, everyone, and welcome. We're so glad you are able to join us for today's session, the One Big Beautiful Bill Act and what this means for you. Before we get started, we are going to do a couple quick housekeeping things. Please use the Q&A feature to submit any of your questions at any point. We're going to be keeping a close eye on these questions throughout the webinar. This webinar is being recorded, and after the session, we will be sharing both the slides and the recording to everybody who is registered. And if you would like to connect with our panel or have any follow-up questions, please feel free to use the email events@kbgrp.com. And with that, I'm going to go ahead and pass things over to Erin Hentrick to kick things off and to share a little bit more about Kirkring Barbario.
Hi, everyone. Before we dive in, here's a quick snapshot of who we are. Kirkring Barbario has been a part of the Sarasota-Tampa community for more than 50 years. We're proud to be one of the region's premier CPA firms, and over the years, we've grown by building strong relationships and helping both businesses and individuals thrive. When it comes to what we do, our services really cover the full range. We provide audit and assurance services to help organizations meet stakeholders and regulatory needs. Our tax team works both with individuals and businesses, everything from preparation to strategic planning. And finally, we have a number of specialized consulting areas where our teams really shine, such as healthcare, construction, real estate, nonprofits, estate and trusts, professional athletes, and international business, just to name a few. So whether it's compliance, strategy, or long-term planning, we're here to help our clients reach their goals. I next would like to introduce our panel here today. First, we have Brian Lydell, Tampa Tax Shareholder and Practice Leader, Kathleen Martin, Outsourcing Shareholder and Practice Leader, Brian Simmons, General Tax Shareholder and Practice Leader, Heather Williams, Estate and Trust Shareholder and Practice Leader, and myself, Erin Hentrick, Healthcare Consulting Shareholder and Practice Leader. All right, let's go ahead and get started. Back in 2017, during President Trump's first term, the Tax Cuts and Jobs Act was enacted. Many of the provisions with this bill were set to expire in 2025. And with the One Big Beautiful Bill Act that was passed earlier this year, many of those provisions were made permanent. And I guess I say permanent in quotes because it's really only permanent until our next administration comes in and changes the rules again on us. So we're not going to go through these ones in detail because they have not changed. Only slight tweaks for inflation. So we're not going to go through those in detail today. There have been a few items that have expired with the passing of the One Big Beautiful Bill Act, and we'll look at those here next. Some of the credits did not renew and were not made permanent, such as the enhanced ACA premium tax credits, which have been a big hot topic in the news lately, the work opportunity tax credits, and the clean energy tax credits, which are all of the energy credits, the vehicle credits, the residential credits, the home improvement credits. Those all have expired either on September 30th or are set to expire at the end of the year. So let's take a look at what is new with the One Big Beautiful Bill. The first one is the auto loan interest deduction. This one is a brand new deduction starting in tax year 2025. It is an annual deduction of up to $10,000 for auto loan interest. And it is a deduction, it's an above the line deduction. And what that means is you can take this deduction whether you take the standard deduction or you itemize. It's in addition to those. So before you all run out and buy a brand new car and get a new loan, let's look at what cars actually qualify and what taxpayers qualify. Because once you read the fine print, you'll see it's not too many people actually are going to be able to take this deduction. So as far as the car and the loan itself, the car has to be purchased in 2025. So if you bought your car December of 2024 and you have a loan on it, that loan interest does not qualify. If you went and bought a 2020 Mercedes last month, that loan does not qualify. It has to be a brand new car purchased in tax year 2025. It has to be assembled in the US, has to weigh less than 14,000 pounds and used personally. So that's the car itself. Then we go to which taxpayers actually qualify to take this deduction. With this new deduction, there is a phase out. And the phase out begins for single taxpayers at $100,000 of adjusted gross income and $200,000 for married filing joint. And then it is completely phased out once you hit $150,000 or $250,000 for joint. So, real life scenario, what does this really look like? Let's say you have a single taxpayer that makes $90,000 a year. They go out and they buy a $40,000 car and it maybe has $2,000 to $3,000 of interest at the end of the year. With this tax deduction, you're looking at maybe a $400 to $600 tax benefit, which better than nothing, but not life-changing tax deductions for you. Before we move on, let me take a quick look at our questions, see if we have any. One of the questions that came in, can I claim more than one car? You actually can. So if you and your spouse went out and bought a new car this year and they qualify and you meet the income requirements, you can take the interest on both cars. Will I receive a tax form similar to mortgage interest? You will, because this is brand new and lenders are scrambling to figure out what this looks like. The IRS has been a little lenient on the reporting requirement. So for the first year, your lender just has to provide you some sort of document saying the total interest that you paid. So they'll either put it on your online portal, on a monthly statement, or send you an annual statement. So we'll see what that looks like as we get more guidance. Okay, let's go on to the next one, which is the deduction for seniors, or you may have heard in the news headlines, no more tax on Social Security. This is effective starting tax year 2025 and runs through 2028. It is an additional deduction for those 65 or older. The deduction of $6,000, and it's per individual. So if you are married and both you and your spouse are 65 or older, you would actually get a $12,000 additional deduction. And this, again, is an above the line deduction. So if you take the standard deduction or you itemize, this is on top of those. The one caveat on this is if you are married and you file separately, you do not get the deduction anymore. You have to file a joint return to get that additional amount. The other piece of this, similar to the auto loan interest deduction, is there is a phase out component. So the phase out on this one is if you are a single taxpayer, once you hit 75,000, it begins to phase out, and it phases out completely once you hit 175. And for joint filers, it's 150 to 250. All right, let me see if we've got any questions on this. If I turn 65 in 2025, do I qualify for the deduction? The answer to that is yes. As long as you are 65 by December 31st, you get the deduction in tax year 2025. Why has this been referred to as the no tax on Social Security? Part of the reason that they say that is there are certain people where that might be the case. It's going to be a limited number of people. With the way Social Security benefits are taxed, there's basically 3 tiers of if your income is in the lowest tier, none of your Social Security benefits are taxed. Middle tier, 50% of your benefits are taxed, and top tier, 85% of your benefits are taxed. So if you're currently in that middle tier and you're right on the edge, this additional $12,000 may knock you down to bottom where none of your Social Security benefits are taxed. But again, it's not going to be that many people. There is still tax on Social Security. Okay, so next I'm going to pass it over to Kat to go through a couple more new items.
Thanks, Erin. The first thing that I would like to talk about is the deduction for the tax on tips. This is starting in 2025. Employees and self-employed individuals who regularly receive tips can take a brand new above the line deduction. So the IRS recently published a list of occupations that qualify. There's a lot, but you're gonna wanna think of the typical ones, you know, servers, bartenders, hairstylists, people that you would typically tip. These do have to be voluntary, cash or charge tips, that would show up on a W-2 or 1099. So things like automatic gratuity wouldn't qualify. The big takeaway here is that the maximum deduction available is $25,000 per year. For self-employed workers, the deduction can't exceed their net income from that business. The really nice thing here is that you don't have to itemize to take this, so more people can actually use it. Like Erin mentioned previously, there are phase outs involved with this one as well. It begins phasing out at $150,000 for single filers and $300,000 for joint filers, and fully phases out at $400,000 for single filers and $550,000 for joint filers. I did also want to mention that the deduction isn't eligible for any specified service, trades, or businesses. So those would be things like consultants. Unfortunately, sorry, consultants doesn't apply to you. In order to qualify for the deduction, if you're a married taxpayer, you do have to file jointly. And beginning in 2025, there is going to be additional statements required to be provided to employees. There is some transition relief, so initially it won't have to be on a W-2 or 1099, but there will be statements provided to you. The next topic I would like to talk about is the deduction available for overtime earned. So this is available from 2025 to 2028, and those who receive qualified overtime pay can take the deduction for their portion of the pay that exceeds their regular rate. So essentially, this is the extra half of the time and a half of overtime. The max deduction is $12,500 for single filers and $25,000 for joint filers. This deduction has many of the same provisions as the deduction on tips, and similarly, it's available even if you don't itemize. Same income phase out ranges apply here, but it is fully phased out at $275,000 for single and $550,000 for joint filers. Also, this only applies to workers who are actually entitled to overtime under the Fair Labor Standards Act. So if you're an exempt worker, unfortunately, your late night emails, they're not going to count. As with the tips, employers who have to issue information will have to issue informational statements showing how much qualified overtime was paid. But there is also transition relief as well for this. So all in all, this and the tips deduction are nice benefits for some workers, and some added paperwork for employers. Next slide. The final change I'm going to be talking about is the change to the gambling losses. Currently, you could deduct gambling losses up to the amount of your winnings if you itemize. Starting in 2026, there's going to be a new limit on losses, and you will only be able to deduct 90% of your losses. So even if you had enough winnings to match your losses, you're now going to be capped. So a good example would be is if you have $10,000 in losses and $12,000 in winnings. Under the new rule, you can only deduct $9,000. So you will be paying tax on $3,000 instead of $2,000 that you would be paying now under the current rules. Just like today, losses can never exceed the winnings claimed. So unfortunately, you can't generate any sort of tax benefit. So all in all, if you're looking for a strategy to beat their house, taxes will not be the answer, unfortunately.
Kat, we have a couple of questions in the chat here. What part of overtime pay actually qualifies for the deduction?
So if you're paid time and a half, 1.5 times your rate, it's going to be that half rate that's going to qualify.
And then what is the maximum amount someone could deduct each year?
So for the tips deduction, the maximum amount would be the $25,000 or limited to your net income if you're self-employed.
Okay, perfect. I think we got through the ones in the chat. We're going to monitor the questions throughout the rest of the presentation, and we'll try to answer as many as we can in the time that we have. Next, we're going to go over to Brian Lydell to go through a couple new items as well.
All right, thank you, Aaron. I'm Brian Lydell. I'm going to be covering a few changes that OBBBA made to itemized deductions and 529 plans. First, there's a new rule for 2026 that will limit the benefit of itemized deductions to a maximum of 35% deduction rate. So obviously, this will only impact those who have income in the highest tax bracket of 37%. For 2026, this bracket is going to kick in at about 640,000 for a single filer and 768,000 for joint filers. Now, I'll get to an example later of how this will actually impact the tax. But now on to charitable contribution changes here. Let's see, we've got the AGI limit for charitable contributions has now been made permanent. So if you're looking to make significant donations each year to public charities, i.e. 501c3 type charities, you can deduct up to 60% of your AGI each year. If you go above that limit, the excess can carry forward for 5 years. Now, note that this 60% limit does not apply to donations you make to a donor advised fund or a private foundation. These have lower AGI limits. Another change to charitable contributions is that for those who are not itemizing their deductions, you can deduct charitable donations of up to $2,000 for joint filer, $1,000 for single filers, in addition to your standard deduction. So this was a benefit that they implemented a few years ago at a lower dollar amount, but they're looking to provide some benefit for those who take the standard deduction for giving to charities. Also on the next slide, we'll go to another revenue raising provision related to charitable donations is that they've implemented a new floor on charitable deductions. So when itemizing, your donations are going to be reduced by 0.5% of your AGI. So for example, if AGI is 100,000, the first $500 you donate to charity will not count towards your itemized deductions. Real world example here. Let's say between these new limits and rules here, let's say a single filer has $1 million of AGI and normally gives about $40,000 to charity. So in 2026, that taxpayer will pay an additional tax of $2,750 as compared to what they would have done under the old rules. Now, if you're a high charitable giver, let's say a single filer with $1 million in AGI and who gives $300,000 to charity each year, you're going to pay $7,950 more in tax than you would have under the old rules. So between the floor here on charitable deductions and the limit on the percentage benefit, you are going to pay more tax in this case.
Brian, we've got a question related to this in the chat here. How do the changes impact qualified charitable distributions from IRAs?
Yeah, and that's a great question. That is actually a strategy we're looking to implement with many of our clients, that it does not impact the deduction you get for qualified charitable deductions from your IRA. So if you are in a spot where you're taking RMDs from your IRA, you can direct those to be paid directly to qualifying charities, and that comes right off your above the line income. There's no limit there. It does not matter what tax bracket you're in. So in that case, you can take advantage of the full deduction at your marginal rate, plus you can also take advantage of the $1,000 or $2,000 amount allowed in addition to the standard deduction. Next, we'll move on to changes in 529 plans. So starting in 2026, beneficiaries can utilize up to $20,000 per year for K through 12 expenses. And these can be used for additional costs such as online resources, fees for SAT, ACT tests and study materials, private tutoring, and also educational support for students with disabilities. Also, 529 plans can now be used for post-secondary and career development. This covers credential, licensing programs, exams, continuing education, and apprenticeship programs. So, not only can this pay for your kids' private school, college, it can also help them pursue their dream to become a CPA and come work for KB. We also wanted to remind you that there was a change to from the Secure Act 2.0 in 2022, which allows unused 529 plan funds to be rolled over to either a Roth account or an ABLE account. It's pretty powerful that if you can roll these funds that are unused into a Roth account, and then again, those can be used for savings years down the road for someone who may or may not have needed those funds for college or post-secondary. All right, next slide. We'll move on. There's been a lot of talk about the Trump accounts. And this is for children who were born between January 1 of 25 and December 31 of 2028. So upon an affirmative election and proof of a valid Social Security number, each child will receive a deposit of $1,000 from the government. Now, those born before 2025 can also open these accounts, but they don't receive the government funds. Then, starting in July of 26, parents and others can contribute up to $5,000 per year to these accounts all the way through the child's 18th birthday, and these funds will grow tax-free. But please note, these contributions are not tax deductible to the parents, guardians, and others who are contributing funds to the account. But an employer can contribute up to $2,500 a year towards this $5,000 limit for children of employees, and these amounts are deductible for the employer and not taxable to the employee. So another tax-free benefit. You can talk to your employers about setting up your kids with these accounts. Then at age 18, the account is converted into a traditional IRA. Withdrawals are subject to tax and potentially early withdrawal penalties. Again, a lot more that needs to be released by IRS for guidance as to how these plans will work. But at that point, the goal here is to be these will convert to a traditional IRA rules. Now, there will be some basis you have in these contributions you make, depending on who made the contribution. But again, that's more detailed than we have right now. And one more change on the next slide to the deduction for state and local taxes. This has been capped at $10,000 for the last number of years. This is going to be increased to $40,000, $20,000 if you're filing separately. But before we get too excited about this, there is a phase out between $500,000 and $600,000 of income. So once you hit $600,000 of income, the limit's back down to $10,000 and fixed at that limit for any income above that. So again, it will have some benefit for those under 500,000, but really, again, it's a quick phase out. So we're not seeing too many of our clients impacted by this increase then. And I think we have a couple more questions possibly.
Yes, there is one question in the chat. Can grandparents, uncles, aunts, etc. contribute through their employers?
Yes, that is. So it's still going to be an employer. Actually, Aaron, you've got this one.
On the employer, on the 529 plans?
Mhm.
Is that actually, it doesn't specify in the question if they're asking about the Trump accounts or the 529s, but I'm assuming it's through the new Trump accounts. There is some provisions regarding contributing through the employer. We're still waiting on guidance on exactly how that's going to work. So we'll circle back on that once we have some additional guidance.
Mhm.
There's one more. There's one more question. These donations to the children's bank accounts could not count as gifts or part of the lifetime exclusion. That, Heather, you might have on that one with the gift tax, the donations to these Trump accounts, they count towards the gift each year.
Yeah, I mean, I would assume I was not, I thought that the question was in regards to another question.
Donations to the children's. If in your questions you could specify which account you're talking about, then we can go ahead and circle back to that one and answer it.
And I do see a question there about the non-deductible amounts to the Trump accounts. Yes, they will create basis in the IRA, which can then be when the funds are withdrawn, that will be recovered as tax-free distribution.
Okay. All right. We're going to go ahead and move on to our next section is State and Trust with Heather Williams.
Hi, everyone. I'm Heather Williams, and today I just want to walk you through some of the major changes in the estate tax law thanks to the One Big Beautiful Bill Act. This really is a big deal for estate planning. It's one of the most significant updates we've seen in many years. And for once, of course, these changes are meant to be permanent, but so no more worrying currently about the sunset provisions. So really, what's new? So they're not going to be temporary like they were under the TCJA. Starting in January 1st, 2026, the exemption is going to jump to $15 million per person. Without the OBBBA, we'd be looking at a drop to about 5.5 million per person. So this is a huge win in the planning world. Plus, the exemption will keep growing with inflation, though keeping track of those numbers in the future gets a little tricky. But let's dive deeper into what this means for estate, gift, and GST taxes. Next slide. So to put it simply, only estates above the $15 million per person or $30 million for couples will owe federal estate tax. For context, the current exemption today is about 12.9 million. And without this law, it would have dropped to the 5.5 or $11 million per couple. So this is obviously a very big increase. The same $15 million exemption applies to the generation skipping transfers, which makes multi-generation planning much easier. This also opens up more opportunities for dynasty trust and long-term wealth preservation for families. For the gifts, the lifetime exemption is unified. So the gifts that you make during life and then what's left in your estate all count towards the same 15 million. But don't forget, there's also the annual exclusion every year. So for 2025, you can give up to $19,000 per person per year without touching your lifetime exemption. So this is just separate and additional. And the IRS reviews that number every year and considers 1,000 incremental updates, but they do not update it every year. They kind of look to the CPI. So for a married couple, they can combine their annual exclusions to give twice the amount to each person. So for 2025, that means a couple could give up to $38,000 to each person without using any of their lifetime exemption or having to report it. So now let's look at what this means for estate planning strategies. So what does this mean for planning? Well, there's an extra $2 million on the table per person compared to the current levels. So that's $4 million per couples. This means a lot more flexibility, especially for business owners and real estate holders. The techniques like estate freeze and charitable planning get a boost. Business succession plannings can take even more advantage, as well as combining this with valuation discounts. But you don't need to wait until 2026. The current exemption levels are still really useful. But always make sure that your gift tax reporting is in order. And I want to note, if you're a Florida resident, you need to consider the other states because they are often lower, their exemptions are often lower than the federal exemption. But one of the most important concepts to understand really is portability. Next slide. So what is portability? So in plain English, it's letting a surviving spouse inherit any of the unused exemption from their partner. So the technical term is called DSU, Deceased Spousal Unused Exclusion. So there's a catch, of course, it's the IRS. You have to file a Form 706 on time with extensions. So I know many are probably saying, why bother? Well, by filing, it could mean up to a $6 million in tax savings down the road. So it's basically free insurance against future estate tax surprises. Of course, they say the law is permanent, and that is government speak, as we know, until further notice or until the next administration change or disagreement. So let me show you a real example of why filing portability matters. So for example, if a spouse dies in 2026 with an $8 million estate, there's no estate taxes owed. But if that same spouse files that executor files a 706, they can preserve the unused exemption of $7 million. So the result is the surviving spouse now has $22 million in total exemption, which could save millions down the road. So filing for portability for larger estates, it's almost always a good idea, even if there's no current tax due on the first spouse to pass. And the dissue cannot be retroactively revoked or taken away by the IRS, Congress, or future tax laws. So to kind of wrap it up here on the estate tax law changes, the new $15 million exemption gives us real certainty for estate planning. My advice, it would be a good idea to take a fresh look at your estate plan. Portability may or may not have been considered when you last updated your plans. And with these new permanent changes, it's smart to review and make sure you're taking advantage of every opportunity. Erin, are there any questions?
Yes, we do have a couple questions here. Are gifts taxable to the recipient?
All right. So no, under the federal tax law, a person who receives the gift is not required to report it as taxable income. And this applies regardless of the amount that they receive and if it's over the annual exclusion amount.
Okay, and this one kind of goes the other way. Can you deduct the gift on your taxes?
Unfortunately, no. Gifts to individuals are never tax deductible for the person who gives the gift. Tax deductions for gifts are only limited or allowed for donations to qualified charitable organizations.
Okay. To go back to the question we had earlier about contributions to the Trump accounts, it does count towards your annual gift tax exclusion each year if you as a grandparent, aunt, uncle contribute to your beneficiary's account. That does count towards your $18,000 per year.
19,000 for
19,000
for 2025, or 38,000 if it's both grandparents.
Yeah.
So you have a lot of room there.
Right. All right. So let's go on to our final section here with Brian.
Thanks, Erin. My name is Brian Simmons. I'm going to be covering 3 business-related categories of changes under this new act. The first one you'll see on the slide in front of you is accelerated depreciation. And there's been 3 very significant accelerated depreciation developments under this act. And you'll see in the bold type, I've kind of highlighted all 3. The first one is the return of 100% bonus depreciation. The second is the increase in Section 179 annual expensing limits. And the third is a brand new category of 100% depreciation for qualified production property, or QPP. So we'll take the first one, 100% bonus depreciation. If you recall, we've had bonus depreciation since 2017, in the first Trump Act. And recently, in 2023, it started to ratchet down by 20% each year. So back in 2023, if you bought a piece of business property that was eligible for bonus depreciation, instead of 100% deduction, you only got 80% of the value deductible in the year of acquisition. It ratcheted down another 20% in 2024 to 60% of acquisition cost. And in 2025, it was slated to be 40%. Thankfully, this new act reinstates the 100% bonus depreciation permanently. So that's very good for business owners. The only thing to be careful of here is your acquisition date. Property has to be acquired and placed in service for 2025 after January 19th. And when I first saw that, that's an odd date. Why not January 1st? Why not June 30th, like we usually see? And then I realized that is the day before Inauguration Day. So just be careful, when you look at your assets purchased for 2025 on the business tax return, that assets acquired before January 19th or not placed in service or placed in service before are required to be under the old rules. The second change to this accelerated depreciation, good news, is Section 179 expensing. Businesses, as tax practitioners, we look at ways to accelerate depreciation for profitable companies. Our first tool in our toolbox is generally bonus depreciation, as long as it's 100%, which it is now. Certain assets are not eligible for bonus depreciation, or it's not a good idea for various reasons for particular clients. And we always look at Section 179 expensing and say, hey, can we take a full 100% deduction under 179? Well, the good news under this new act is the old limit pre-act was $1,220,000 per year of assets could be eligible for Section 179. That is increased to 2.5 million. And again, that's going to be indexed for inflation, just like the prior number. So that's also good news. The third category is the category of accelerated depreciation that's subject to the most misinterpretation or lack of interpretation because we don't have a lot of guidance. And that's this idea of qualified production property. And this new tax act created a new 100% deduction for qualified production property. What is qualified production property? It's any portion of non-residential real property located in the U.S. that is integral to the taxpayer's manufacturing of tangible personal property. So in layman's terms, a factory. And the misconception, I believe, that you'll see in a lot of the newspapers is starting in 2025, I can build a factory and expense the whole thing. And that's just not true. There's a lot of limitations to be careful of. Clearly, Congress wants to help manufacturers and bring manufacturing to the U.S., but there's a lot of limitations, a lot of lack of authority in this area right now, but I'm going to go through some of the basics with you. So for new property or a new factory that you're building, construction has to begin after January 9th, 2025, but before January 1st, 2029, and the new facility has to be placed in service before January 1st, 2031. There's also rules for used facilities. So and it's really aimed at, not buying a ready to produce factory. It's more, hey, I'm buying a warehouse and I'm going to fit it to produce tangible personal property. What are the rules? And the basic rules are they don't want you to take this deduction for property you've previously owned or a related party has previously owned or someone else has used as a production facility previously. It's got to be something you buy at the outset in a used condition and refurbish, basically. The most important thing to remember, I think, now is qualified production property does not include portions of a building used for offices, administrative services, parking, sales functions, research, engineering, or other functions unrelated to producing tangible personal property. So, that's if I produce, a facility, a lot of that is not going to be eligible. The expenses to create the offices are not going to be eligible, and it's clearly some kind of cost segregation study is going to have to be done to justify what we do expense for something like this. With all the limitations, this is still a big change from prior law, because previously, if we built a facility like this, most of it would be subject to 39-year depreciation, which is not nearly as favorable, obviously, even if we get a piece of it that we can deduct right away. Many areas require more guidance. What qualifies, what part of the building qualifies. There's a definition that the property has to be integral to the taxpayer's manufacturing activity, but it never defines what integral is, what portion of the building, and how do we even make the selection on the tax return. There's no guidance on that either.
Brian, we've got a couple follow-up questions. For the bonus depreciation treatment, if you are one of the unlucky ones who bought something between January 1st and January 18th, what kind of depreciation do you get?
You get under the old rules, so you'd be subject to 40%, bonus depreciation. And again, if it was either you missed the placed in service or the purchased deadlines, so you'd be subject to 40% instead of 100%. Next slide. The next topic is research expenses. And again, this is just a huge change for business owners that did any kind of research and development. If you recall, since 2022, we've been required to not deduct as we incur them, but to capitalize and amortize over 5 years research and experimentation expenditures incurred by companies. Before 2022, they were ordinary and necessary business expenses, and we just deducted them. But we've been capitalizing a very unfavorable treatment for what in most people's views is an ordinary necessary business expense and an expense that is great for the economy. So the new tax act changed that, and it brought back the pre-2022 immediate expensing of research and experimental expenses starting in 2025 and going forward. Great news. What it also did is it gave us some guidance on what to do with all those deferred expenses that we've had to capitalize and amortize over 5 years that we haven't taken yet, in the years 2022 and 2024. And, that's the real issue that accountants are struggling with and business owners will be struggling with, is what to do with those deferred expenses under the old law. And what to do depends on which of two tracks you're under. There's a special rule on the first track for small business owners. Small business owners, and I'll get to that definition in a minute, they can elect to go back and amend their business tax returns for 2022 to 2024 and get a refund of, take those expenses that were deferred and not taken yet and hopefully get a refund or get a refund, obviously, and reducing their income. If you're in a small business owner is defined as a business that has average gross receipts under 31 million for the tax years 2022 through 2024. So you don't have to go back and amend, but you can elect to go back and amend if you qualify as a small business. So what if you're not a small business? Well, if you're not a small business, it's all prospective treatment. So starting in 2025, not only do you take your current 2025 expenses, but you can take all your 2022 to 2024 expenses, which you haven't deducted over 5 years previously, and take them either all in 2025 along with your current expenses, or you can take half of them in 2025 and half of them in 2026. So again, a great deal. Any questions on that one?
There's a question on the R&D piece. Why would a company that qualifies as a small business not want to amend their 2022 to 2024 returns and get their refund now?
And we've done there was all kinds of special rules that came out just recently. We've done a lot of analysis on this for clients where it's been a hot issue earlier than expected for a variety of reasons. But basically, if you're a pass-through entity, so a partnership or an S-corp, it's not just the business tax return amendment that you're worried about, because you also have to go back and amend the returns of all the owners. So the reduced income will pass through to the owner's return, and that's where you have to look at the tax situations of all the owners and determine if there's reasons why that would or would not be a good idea. So that's one consideration. Another consideration is the state of the IRS right now. Shut down right now. Even before the shutdown, if you amended an old return, sometimes it would take up to a year to get a refund. So you're kind of balancing, do I amend prior year's returns and wait a year and a half for my refund, or maybe more now with the shutdown, or do I just wait until 2025, take it then and maybe get it even sooner, my refund, and not have to amend and include it in the owner's current returns. Okay.
There's one kind of follow-up question. Can you do the catch-up if you're a small business?
Yes, you don't. When you say catch-up.
The catch-up, I believe the catch-up deduction for those that don't qualify, if you do qualify as a certain small business, can you decide just to do the catch-up and not amend? I think.
Yeah, if the small business it has the ability to make an election to go back and amend, but they don't have to. They can wait and just take it all in 2025 or 2025 and 26, definitely. Any others? All right, next slide, please. My last business-related deduction is meals and entertainment. Deductibility of meals and entertainment has always been just a spider web of tax authorities, for us, just related to specific situations. There's private letter rulings, there's code sections, there's regulations. It seems like a lot of it's been fact specific, and I've seen grids of what's deductible, what's 50%, what's 100%. The new law made one very unfavorable, not money wise, but just unfavorable for taxpayer businesses change. It used to be that on-site meals for employees were 50% deductible. And the change that was made in this new tax act was that on-site meals for employees, for instance, employees working late, buying dinner for employees, lunch, meetings, workplace, break room snacks and coffee, those types of things for a long, long time have been 50% deductible. They're not deductible at all, starting not in 25, but in 2026. There's some really unusual exceptions to that, which don't apply to really anybody other than maybe restaurant owners, where if you give meals to your employees, those still are, 50% deductible. But the important thing to remember, in addition to the big change, is that some rules remain the same. In my mind, the important ones. Meals with clients or customers are still 50% deductible. And employee parties like Christmas parties are still 100% deductible. So those items remain unchanged. Now back to Aaron, if there's any other questions.
All right, so if you've got any follow-up questions, please go ahead and put them in the Q&A section of the presentation, and we'll take some time to go through anything that we've missed here before we wrap up for today. Kat, I think this question would be for you. For tax on tips and overtime, is there something I need to do in payroll for tips and taxes so they aren't taxed for my employees?
Yes, so can you hear me? Okay, I know there was some trouble with my sound before.
It's still a little low.
Is it? How about now?
A little better.
A little better. Okay, see how close I can get to the computer. So you'll want to make sure that if you're doing manual payroll, you have a way to track your tips and separate them out from regular payroll or your overtime. If you're in a payroll service provider platform, they're going to start making those changes if they haven't already to track them. Luckily for 2025, there is some transition relief, so it won't be quite as stringent, but going into 2026, for sure, you'll want to be able to put it into the different box in the W-2, or if it's 1099 that you're paying someone, you'll want to be able to track that in a separate box in the 1099.
I do see there's two of the same questions, so let's go through this one. Brian Simmons, are there any limits on 100% bonus depreciation? I'm assuming they mean limits as far as how much you can take, the amount you can take. Oh, you're on mute.
Sorry, it's unlimited for bonus, unlike 179.
Brian Liddell, this one for the 529 plans, you had talked about rolling over the 35,000. Can you do all 35,000 in 1 year?
No, it's subject to the same annual limitations as a regular IRA, a Roth. So 7,000 per year for those under 50.
Another question, should I think about doing a donor advised fund in 2025 for charitable contributions?
Yes, yes. So that would be if you're in the 37% bracket, it would be beneficial to possibly overfund a donor advised fund in 2025, let the excess carry forward because the new limitation that reduces the benefit only applies to contributions made in 26 and forward. It does not apply to any amounts that are carrying forward.
It's an interesting question. Are employee meals while traveling 100% tax deductible? This goes back to your fun grid, Brian. Bucket does it fall under?
Yeah, again, the grid, I would assume that's 50%. It's not on-site meals of the employer, which is what went away for sure.
Right.
So I believe it's all the same old rules.
Any changes to the QBI deduction? So that was one of the items we didn't go through today because that was one that's made permanent and it hasn't really changed. The only change to that is a slight increase for inflation as far as the phase out goes. Brian Simmons, I think that's another one for you. What isn't qualified property? Can I write off my new roof?
Roofs are and always have been tricky.
Oh, stalled on us. We'll see what happens. Oh, here he comes back.
Can you hear me? Sorry.
Yeah, sorry about that.
Roofs have always been tricky. I think you might have lost me again. Bonus depreciation. Roofs are 39-year property. Complete replacement of a roof. If it's a component of a roof, it has to be 20-year property or less for bonus. So if it's, repairing a roof or a component of a roof, possibly bonus, you see more roofs expensed under Section 179.
Here, what other questions we have? Checking to see which ones we haven't answered here. Are there any deductions for business vehicles, equipment like forklifts? I believe those would be considered with the bonus depreciation rules because they're under 20-year property. So you would get the bonus depreciation for any type of business vehicle or forklifts. The business vehicles, there are some additional nuances to that. But equipment like forklifts would qualify for the bonus. Kat, how should my business begin planning for overtime and tips reporting?
Then I would just make sure that you can track it separately. Some things you may want to talk to your employees about though would be updating their W-4 so that if they are expecting this deduction, they can update the W-4 and change their tax withholding so they may not need to get it all back when they file their tax return and instead can get it back over time through their paycheck.
Thanks. There's another one, construction equipment, full expensing first year. Again, I think this would fall under the bonus construction equipment. It's under 20-year property, so you'd qualify for bonus and fully expense it in the year of purchase. This is an interesting one. If I buy a building and I add a kitchen and a bathroom and turn it into a bakery or restaurant, does this apply? I'm assuming that is related to that qualified property.
I can see all kinds of esoteric issues there. So is this the one that I'm looking at? Is this the one that they were creating a restaurant, or is this a different one?
Yes, they're turning into a bakery or restaurant. I think it has to do with that creating a plant.
Yeah.
I don't think that
Have
would
they-
qualify.
Have they changed? Is a restaurant transforming, creating tangible personal property? Is a donut tangible personal property? Is a hamburger tangible personal property? That's that's the question, and there's no guidance on that. My guess is probably not.
I think we got through. If you've got any other ones, please make sure you're putting it in the Q&A. There is a second follow-up here. I read that restaurants and breweries are not eligible, which I would agree with that. I don't think they would qualify as manufacturing. But again, we'll wait to get more guidance as more rules come out here. Okay, well, if I don't see any more questions, I guess we'll go ahead and wrap up here today. If you do have any follow-up questions, please feel free to reach out to us. Bethany earlier had the email here again. Oh, here you go. Thank you, Bethany. If you do have any additional questions, go ahead and email the events at kbgrp.com or call us, and we are happy to answer any questions that you have. Thank you all for attending today.